Shastri Bicycles of Mumbai, India produces an inexpensive yet rugged bicycle for use on its city's crowded streets that sells for 500 rupees. The Indian currency is denominated in rupees and denoted by a capital R. Selected data for the company's operations last year appears to the right. Compute the unit product cost for one bicycle using absorption and variable costing. Recall, in absorption costing, full absorption costing, which is GAAP-based, we treat all manufacturing costs, direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead as product costs, where in variable costing, only direct materials, direct labor, and variable manufacturing are considered product cost. Our fixed manufacturing overhead will flow directly to the income statement as part of cost of goods sold. Let's go ahead and begin. We're told our direct materials cost is 120 rupees per bicycle, our direct labor cost 140 rupees per bicycle, and our variable manufacturing overhead is 50 rupees per bicycle. Since our fixed manufacturing overhead is 600,000 rupees in total, and we produce 10,000 units, our cost per unit is 60 rupees, giving us a total manufacturing cost of 370 rupees per unit under full absorption accounting. Under variable costing, our fixed manufacturing overhead goes directly to the income statement as part of cost of goods sold, and so we have zero cost that is included in the inventory value. So our total variable cost per unit is 310,000 rupees. We're told that sales for the year are 4 million rupees. That's the 8,000 bicycles we sold times 500 rupees per bike. Our cost of goods sold then will be 2,960,000 rupees under absorption costing, which is the 8,000 bicycles times 370 rupees per bike, giving us a gross margin of 1,040,000 rupees. And again, that's simply sales minus our cost of goods sold. Our selling and admin expense will have both a fixed and a variable component. The fixed component is 400,000 rupees, then the variable component is 20 rupees per bicycle times the 8,000 units or bicycles that we sold for a total of 560,000 rupees, giving us net operating income of 480,000 rupees. The value of our ending inventory will be 740,000 rupees. That's the 2,000 units in ending inventory times 370 rupees per unit. Under variable costing, we have the same amount for sales. Our cost of goods sold, however, will be slightly higher because all of the fixed costs flow directly to cost of goods sold. We take our fixed manufacturing overhead of $600,000 per unit and add to that the 310 rupees per unit times 8,000 units for our variable cost, for a total of 3,080,000 rupees. This gives us a gross margin of 920,000 rupees. We have the same selling and admin expenses of 560,000 rupees, which again is the fixed component of 400,000 rupees, plus 8,000 units times 20 rupees per unit, giving us a net operating income of 360,000 rupees. The value of our ending inventory will be 620,000 rupees, which is simply, again, the 2,000 units in ending inventory times our variable cost per unit of 310 rupees. Notice the differences then. We have 120,000 difference in cost of goods sold and $120,000 difference in net operating income and ending inventory. The 120,000 rupees is the 60,000 rupees per unit in fixed manufacturing overhead cost times the 2,000 units that we put in ending inventory. So under absorption costing, our ending inventory is higher by 120,000 rupees because this amount of the fixed cost is capitalized or recorded as inventory, where under variable costing, the entire 600,000 in fixed manufacturing overhead flowed directly to cost of goods sold and was treated as a period cost. So again, under absorption costing, we will report higher inventory values by 120,000 rupees, as well as higher net income, which of course translates to higher retained earnings in the amount of 120,000 rupees.